TheoTrade. This is Don Kaufman. April 1st, 2021, doing the TheoTrade weekend update here on a Thursday afternoon. The markets will be closed for Good Friday. Nevertheless, the futures market will actually be open. We're still going to get a jobs number out on Friday morning. However, we're coming into a 3-day weekend. With that, here we go. Let's get down to business on this weekend's update. Traders seem to be aggressively ignoring risk. We're going to explain that and much more. Let's start with the fact that all-time high inside of the S&Ps. So the S&Ps finally did it, cracked over the 4,000 level. It's almost tough to say, seeing how portions of my career, the S&Ps were in the 600 handle. Now again, trading over the 4,000 handle. But we'll start with the fact that, yeah, again, we're all-time highs, but you still have this kind of uncertainty feel to the marketplace at all-time highs. And I think a lot of that uncertainty, and I'm going to explain it in this weekend's update, but a lot of the uncertainty for me has a lot to do with what I kind of call correlation chaos. At least in my mind, we're completely, broken apart in terms of correlation chaos. And again, I'm going to explain a lot of that. That's actually going to be one of the big focus of this weekend update is looking just at that. Like, what kind of chaos am I referencing? So the first thing that I want to reference, though, in this weekend's update is in sheer respect to the fact, yes, the S&Ps did crack into all-time high territory, but we've been kind of flirting with it, a hop, skip, and a jump away. But as we crack into all-time highs, the market as a whole did nothing unusual. I mean, the expected move is roughly around $60, and we didn't even move necessarily $60 on the week. We are still a hop, skip, and a jump away from the upper edge of the expected move. And that, to me, from a statistical point of view, and that's the way I always try to view the marketplace. I try to take a really, really quantitative approach. It's like, listen, it's not about what you think. It's about what do you know? What did I know? Well, we said this on Monday afternoon that for the most part, it's a 4-day trading week. We're expecting a $60 move, and we kind of anticipated that we would get every penny of that $60 move. We came up a little bit shy, and again, if you take a look at the S&Ps, they closed right at about 40.20, and that upper edge right there, that upper edge sat at about 40.33. So we were just about 13 S&P points shy from hitting the upper edge of the expected move. I think where I'm a little bit surprised, though, in this, and that's why I'm like, uncertainty in the marketplace. I know it sounds scary, right? But you come in here, you start looking at auto expected moves, and this is expected moves like of the IWM. So the IWM is nowhere near its all-time high, and it had like kind of a meager rally. So it ended up the week mildly higher. Then you look at the NASDAQ. All right, you got me. The NASDAQ was on fire, but the NASDAQ is still nowhere near its all-time high. It did close right at the upper cusp of the expected move on the week. But again, that's why I'm like, kind of, well, yeah, you do have all this uncertainty with the S&Ps effectively at all-time high. And then you look at this and you're like, well, then how is the S&P at an all-time high, right? You start thinking to yourself, like, wait a second, this makes a good point over here because the NASDAQ's nowhere near the all-time high. What is driving the markets? And some of that we're actually going to get into here. But everything is up, except not everything is up, okay? Take a look from an advanced decline line perspective. Most of today's trading session, all right, and here we are again, a Thursday afternoon, most of today's trading session was sitting at a 50-50 advanced decline line. There was actually a portion of time when the marketplace was rallying. The advanced decline line was closer to 60-40 decliners. So for the most part, not everything's up. You had Nike that was actually down today. Walmart negligible. Take a look. Even some of the big players like a Tesla. Tesla's actually off by 1%. Okay, Boeing, I'm just looking down the list, some of the usual suspects, stuff that's on my screen, it matters, right? Boeing's off by like 0.7%, Baba's off a little bit. So there was actually some players that weren't necessarily involved per se inside of the rally. So we're not getting a great, correlation coefficient, which again, I'm going to reference here in a moment. Now, before I go that direction, it is important to also understand volatility got crushed. We are now, okay, by far and away, look back over the last 3 years inside of the VIX, okay? Since the onset of Corona, we're now by far, as I said, in a way, the lowest volatility that we've seen. The VIX it's getting down there, but the VIX is down. Hold on for a second. Okay. Then we look at what's called the VVIX. That's the volatility of the VIX. that, people, really is also at one of its lowest points. So this is the VIX of the VIX, which is it kind of prices options in the VIX. So if you looked at option pricing in the VIX, the option prices themselves in the VIXs are also incredibly low. We have a massive, again, a massive contango inside of the volatility futures. If you've never looked at volatility futures, they're like, ooh, volatility futures sounds very exciting, but volatility futures are low. But I'm referencing, like, again, this just hideous contango that exists in here. This is a better representation as it snaps onto the screen. I was a little curious about that one myself. What I'm talking about is, here's a curve from a few weeks ago, and here's a curve right now. What this basically means is, this is like, front vol versus some of the back month vol, and that is one just wildly steep curve. Again, just a couple of weeks ago, it said like risk, okay? Risk right now was almost the same as risk into the future. Now, risk right now is like negligible. Risk in the future is considerably higher. So again, we've actually fallen into like a wild contango. If you're kind of curious about those curves, the curve actually came from December 11th versus, today. So a couple of weeks ago, just over a quarter ago, I just took a snapshot in time just to give you an idea of how different volatility actually looks from, again, a couple of weeks ago. And if you're more comfortable, you can actually bump the curves up over here. All right, let's get crazy and show you like a little bit of a differential of the curves. And it takes a moment to actually pull some of the data on here to actually elaborate upon a handful of curves. Nevertheless, okay, the curvature and the change of the curvature is almost like alarming. How again, and here we are. This is a period of risk where it's actually showing risk in the present was greater than risk in the future, and right now, again, the curvature of volatility is rather dramatic. So what does that mean? One of the things that it does amount to, and I talk about massive contango in the volatility futures, but when you start looking at the spiders, let's shy away from the SPX and start looking over at the spiders, and you open up the spiders. Okay, one of the things it means is if you're actually looking for some volatility, you're not going to find that volatility. You're not going to find that volatility in the shorter durations. So you'll like 15 days out, it's like a 15 vol. But what's really, really crazy about this is, in the short duration, there's like no volatility. When you start going out though, like, 70 some odd days, it's all the way back up to like 21%. It ain't cheap. That ain't cheap at all. So, all the way 106 days out, you're at a 21% volatility. That volatility is still rocking. And one of the craziest things about this, because we're going to talk about correlation chaos in just a second, but when it comes to volatility, the volatility itself has its own chaos. And that's why I'm telling you that traders, it feels like they're aggressively ignoring risk. In all due respect, okay? So there's this massive like volatility differentiation between the S&Ps and the Russell. And this is something I've been pointing out. Take a look at the Russell, okay? Seriously, take a look at the Russell. Look at 15 days out. Like, I don't care what trading application you want to use over here. Look, 15 days out in the Russell, it's 26 volatility. Look, jump back to the spiders. Okay, we're going to jump back over to the spiders. Come on, go to the spiders. Spiders, 15% implied volatility. Now, some people are like a little lost with this, like, oh, so what does that mean? I mean, do you really think that the Russell that much more volatile? Think about that. And people, you have to look at this as like it's a $15 stock and it's a $26 stock. And again, this is a massive differential. And then you throw in the QQQ, and the QQQ 15 days out has about a 21 vol. Again, the differentiation in volatility. And you can actually come in here and compare and contrast this. And I didn't even set this up because I wasn't planning on going this direction. But if you pull up something like the VIX, okay, you pull up the VIX and you go over here to add study, okay, and we go compare with. You can go to the VIX and then type in like RVX. Do this on your own, okay? Have a party, people. Do this on your own, and then come in here, back to studies, okay, and go compare with, all right, and type in like VXN, which is NASDAQ volatility. So RVX is actually volatility in the Russell. VXN is volatility in the NASDAQ, and the VIX is obviously the S&P 500 volatility. Then we have to actually change the VIX, okay, on the primary screen. To come under style. If you go under style, switch from candle, go to line. Okay, now what you're actually looking at is kind of on a percentage basis. It's a percentage basis, so don't worry about the scale over here. It's just on a percentage basis, but it gives you an incredible visual of the differentiation of volatility, where these volatilities during periods of volatility, they all move in perfect unison. Okay, but the volatility crush right now, not all volatility crushes are created equal. This is some really, really serious stuff over here, because it's actually displaying, volatility is displaying this correlation coefficient breakdown over here. All right, so The other aspect of this, and you know, I'm just going to bleed into correlation chaos for a second, is when you start looking at like the bond product. Bonds today, and I know you see 4 ticks, but the bonds today were up and up big. Take a look at like the TLT. TLT was up like 1.5% today. You realize that the bonds were up, and as bonds are up, okay, that actually takes the interest rates lower. Interest rates are lower. That doesn't help the financials, but at the exact same time, the financials rallied back today. In fact, when you look at the financials and pull up auto expected moves, the financials actually finished the week massively unchanged. That's actually been an object of my affection lately. Okay, so now as we bleed into that, we want to talk a little bit about correlation chaos. Okay, and what I kind of call correlation chaos and where I'm actually going with this. And a very unique perspective of why do I actually say, you know, the title of this weekend's update is Traders Are Aggressively Ignoring Risk. First of all, okay, again, when you start looking at the marketplace and you step back objectively, it's kind of crazy that, again, the Russell volatility is in like one extreme. The NASDAQ volatility is in also a portion of another extreme, and the S&P volatility is kind of caught in the middle. That's because the Russell and the NASDAQ seem to kind of be offsetting one another, and trapped in the middle is none other than the spiders. Okay, that part makes sense to me. Okay, and then the bonds. And then the bonds make a lot of sense to me too. So the bonds, well, we're going to talk about that here momentarily. The bonds are driving a lot of the financials, except today, because the bonds are bid and the financials, okay, were also being bought up, which makes absolutely no sense. But when you start to think about, like, you know, correlation breakdown, like, you know, constantly hearing the word inflation. Okay, I've heard the word inflation to the point that I'm like, you know, I'm becoming like literally objecting to it. It's an objectional thing when I'm actually hearing the term inflation. Like, again, my response is to either get sick or like to throw something. But I constantly hear inflation. And then, so I look around at some of the, you know, the metals and so forth. And I look at metals and I look at the oil and I'm like, inflation. Okay. I've always heard during periods of inflation, gold will soar. Okay. So of course, you know, gold has not exactly been soaring over here, but then everybody turns around and they go, no. Gold's no longer an inflationary tool, sir. Gold is no longer the inflationary tool, because now I got to hear that crypto is the new gold. Okay, so, oh, great. So, yeah, you know what? So are NFTs, if you're not familiar with that. Non-fungible tokens. So anyway, so I got to listen to the Bitcoin, you know, discussion that this becomes the new gold. All right, you had me over there. But then what doesn't make sense is if Bitcoin is also rallying, okay, you've also got the dollar. The dollar's been wildly bid. Okay, you got me. The dollar actually backed off today. But I want you to start thinking about all of these products, okay, in their cohesion. I want you to start thinking about like correlation chaos, because it's, you know what, you're never going to be able to sell yourself into the idea unless you're blinded to see what's going on over here. You're not going to be able to sell yourself into the idea like inflation. Okay, nobody needs to start talking about that until we see some of the metals possibly flying. Okay, until we actually see correlation start to make some more sense out of this. All right, to the dollar, which everybody's talking about how the dollar is being devalued horrifically, really, because I see it nothing but rallying, because I've always said this about the US dollar. In the end, where are they going to go? You know, talking about the U.S. dollar, and I've heard it's no longer going to be the reserve currency of the world, and yada yada yada. Except that they're buying dollars right now, and this is buying dollars in a huge way. Actually, if you break this up into even a 5-year chart, that is a vicious move. It's in fact one of the most vicious moves to the upside that we've seen. Okay, since again, you have to go back and you have to start to talk about some really, really wild times inside of the marketplace. This is in early 2018. Early 2018, the marketplace got a real scare. Okay, everybody actually ran into the dollar in this particular case and did so for a considerable period of time. The other major scare, when you actually snap this, let's snap it to a 3-year, this humongous spike up in the dollar. Again, up in the dollar was actually risk brought on, of course, by COVID. After COVID, of course, we back off. Here's a huge bid. We'll actually see. I would anticipate the dollar to continue to back off for a couple of days before exploding back up. You could even see the dollar back at the 95 handle. All right, onward and upward over here. So when I talk about correlation chaos, this is not me arguing for inflation or against inflation. It's just that, you know, some of the products over here don't necessarily make a lot of sense. Okay, in light of the fact that, you know, the marketplace, you should see S&Ps are going higher. Does that mean the metals should go down because there's not that much risk, but if there's inflation, those should go up? And then if you're at a loss of words and all of this, you look at this and you step back, you're like, I don't get it. You should be at a loss of words. Okay. Are you? No. Okay. We lost an asset class. We lost an asset class, and I think this has a huge amount to do with it. Now, this is going to be a little bit of an opinion piece when you take a look, though, at the bond product. The bond product, we lost an asset class. We lost bonds. Okay? When we say we lost bonds, yeah, bonds are seeing some sell-side activity, but nevertheless, there's very likely a Fed put in place in the bonds. Okay? And with a Fed put in place, meaning that if the bonds continue to sell off, okay, there's going to be a floor under the bonds. And now a floor under the bonds is the exact same thing as actually saying there's going to be a ceiling inside of interest rates. Maybe the TNX can't really get above, okay, maybe 2% in this particular case. So with that, even though we don't necessarily have yield curve control is when the Fed actually comes in there and tweaks, the 10-year, or they tweak the 5-year, they tweak the 10-year, they tweak the 30-year. They can do whatever they want, and they'll actually start to peg, okay, these products. Nevertheless, it's almost like the marketplace is already anticipating it. And because the marketplace is anticipating this, you lose a certain asset class, okay? And what that basically does is it has side effects. So when we talk about correlation breakdown, correlation chaos, and you see 50-50 advanced decline lines in the marketplace going up, and the market cap of a Tesla, and the market cap of a Facebook, of an Apple, of a Google, of an Amazon, if those things it just doesn't even make sense anymore, it's because we lost. Okay, one of the primary asset classes. And yes, I do actually point some fingers towards the Fed on that one. Nevertheless, okay, I think this has a very, very large portion to do with it. And that's why people are scratching their heads on inflation. And again, my distaste for the word inflation has nothing to do with my outright feelings on inflation. I'm not here to argue for or against it. What I am here to do, though, is to point out when you have an asset class missing, okay, you start to get chaos inside of the marketplace, which also brings me back to the fact that it's one of the reasons I think that traders are aggressively ignoring risk, okay? And that's no longer a question. That's actually a statement, all right? Why are they aggressively ignoring risk, okay? And we'll actually come back to the SRVIX in a moment here. But so throughout the course of this week, all right, as I say, traders are aggressively ignoring risk. Throughout the course of this week, we heard a lot, of course, about Bill Whang and his fund ultimately blowing up. And that had some effects, okay? And it had some big effects on individual stocks. And you can take a look at Viacom. And the one reality, though, in this particular case, and what can actually be discerned from Bill Whang actually blowing up, is, first of all, it was nothing more than a flash in the pan. This fund actually blows up. The only real bank that was negatively impacted, I think you could point fingers towards Credit Suisse, okay, who took a huge hit. It was basically coming into this was a $13 stock. Okay, it's now down close to 30%. We'll call it 25-30%. If you take a look at Goldman Sachs definitely took a hit on this particular front. But as I said, wow, up in flames, and they bought it. They turned around and bought it. When you actually look at auto expected moves speaks volumes. Basically started and ended the week at the exact same place in terms of Goldman Sachs. The other bank that, of course, took a little bit of heat and would be Morgan Stanley. Morgan Stanley did actually finish the week slightly lower, not exactly demonstratively lower. But the reason I want to get you guys thinking about this is, and again, you can see it now a little bit more clearly, and that's why I wanted to actually bring this to your attention, is that there may be some great opportunities, some incredible opportunities. As I said, traders, they seem to just kind of outright ignoring risk. And part of the reason is this: low returns in the marketplace. And we've seen some really key people, okay? So we could actually talk about like ARK funds. I mean, everybody's following this disaster right now, right? So Kathy Wood's ARK funds, she's an absolute legend. She's going down in flames right now. If you look at the year-to-date percentage, it's still down like 3%. But low returns, okay, cause even intelligent people to do incredibly stupid things. And I mean, horrible, horrible things. One of the things that we're finding out right now is concentrated equity risk. Now, I'm not here to tell you that, there's going to be another ARK or there's going to be another, Bill Whang out there. I'm not going to tell you that. I'm going to guarantee that. Okay, and now all of your major banks are going to start to look for it. And I was talking about that, of course, in Monday evening's video, how all the risk managers, it's going to take about 2 to 3 weeks, and they're actually going to cycle through. But it's not about an ARK, and it's not about a Bill Whang. Those are actually predominantly stock positions. It's going to be a wild derivative-based position that these firms are really going to be concerned about. So as I was saying, there's one thing that continues to kind of bother me. And what bothers me on this front is if you look at the, and if you've never seen this before, you can pull this up on your own platform. It's SRVIX, which is an interest rate swap, okay, volatility index. Now, interest rate swaps, people are like, oh, I don't even know what an interest rate swap is. It's an institutional level product. It's an over-the-counter product. But one of the things that really resonates with me, swap vol right now is approaching. Basically, it's recent high. And you talk about like the marketplace, okay, and this and that. One of the things that doesn't necessarily jive right now is the fact that, the bonds feel like they're kind of temporarily under control. Except when you look at like swap volatility, you start looking at the TLT, look at the TLT, open up 15-day in the TLT. The TLT volatility is basically the same. The TLT volatility is basically the same as it is inside of the VIX, inside of the S&Ps. That one definitely bothers me for a product that I just said is likely dead. It's still carrying a huge, huge premium to the bond product over there. There is mounting risk, and that risk, okay, unusually, it's not mounting necessarily where we would expect it to. So we believe that there's a Fed put that's in, and I think the assumption in the marketplace is that there is a Fed put in there, that the Fed is going to be able to backstop anything and everything, okay? I also think that that's an incredibly huge mistake, that there's always going to be a degree of tail risk out here, and in very large part, it's why, okay, and for those of you that do speak geek, it's why we're seeing things like what we term skew. In fact, I'll just type it in over here. It's why skew, okay, remains incredibly high. All right, 136, okay, all the way up into the 140 handle. Skew is out of the money puts inside of the S&Ps versus out of the money calls remains relatively high. I think there's still some edge inside of traders, okay, for traders inside of the skew alone. But one of the great advantages, if volatility continues to subside over here, okay, the ability for us to come in and actually be net volatility buyers, okay? We're going to go out there and we're actually going to sell premium in a handful of products that still have relatively high volatility, okay? And we're actually going to be able to buy volatility in the VIX to mitigate the risk of the premium that we're selling. So we're actually going to do almost like a little bit of a volatility arbitrage from one product to the other. I know that's a little bit wild, sounds a little bit crazy, but this is something I'm going to be explaining throughout the course of this next week here on TheoTrade. There is great edge, okay, in the sale of premium. I'm going to say that again. There is great edge right now in the sale of premium. Why? Okay, because we got correlation chaos going on. I mean, there's great edge in the sale of premium, but you have to know how to mitigate the exposure, because you have to expect, all right, that there's going to be too many traders that are aggressively taking those shots inside of the marketplace. In fact, you should bank on it that the traders are out there aggressively taking, on just heaps of risk, and they're doing it because the marketplace, hey, it ain't easy. Again, you're seeing people like Cathie Wood just shove more and more money inside of a Tesla, and like it just keeps falling. Okay, who is next to go up in flames? Whoever it is, let's hope it actually is not necessarily in the derivative side of the business, which could actually have, again, a little bit more of a domino effect. All right, last but definitely not least. And again, there's some wild concepts that I'm throwing at you guys on a weekend update. It's a lot to think about over the weekend update. And I know that everybody was like, man, can you just tell me if Apple's going up or down? People, that's not it. What is at stake right now in this business? What's at stake in this business right now is when you see what you heard was the best of the best. It was a Bill Whang. It was a Cathie Woods. And they're choking on their positions right now, literally and figuratively choking on their positions. Somebody goes up in flames and the marketplace cheers it and buys it. Do you not see, okay, that they're aggressively risk-taking? Do you not see that they don't give a crap, okay, about what is at stake? You need to. This is your livelihood, this is your risk, and it's your capital. And there's edge in there all around this aggressive risk-taking. Again, last but definitely not least, I always like to talk about the expected move. Why? Because it's what rocks the marketplace. Expected move inside of the SPX for this previous week of trade, the one that we just passed through, was a 4-day week. Again, it was right around $60. We came just shy of a $60 move. I mean, come on. What happened throughout the course of this week? absolutely nothing. Everybody's like, it's an all-time high. But it's not an all-time high in the NASDAQ. It's not an all-time high in the IWM. It's just an all-time high inside of the S&Ps. Nevertheless, that all-time high in very large part was actually brought to you by the financials. Okay? The week that we're coming into, of course, the week we're coming into is going to go back to a 5-day trading week, but yet we only have about a $58 expected move. So the expected move is actually lower than a 4-day trading week. Think about it for a second. Volatility, people, it's collapsing all around us. It's a time, okay? And I want you to think about this. Short duration, for those of you that are a little newer to this, in the short duration, okay, we're actually going to be buying volatility. In the longer duration, we're going to be selling it, okay? Meanwhile, we have to still hedge some tail risk. Again, that and much more is going to be explained throughout the course of this week, okay, live on TheoTrade. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.